Hi, I'm Patrick Doyle. Welcome to Thailand. One of the many things I find interesting about Thailand is the fact that it was the epicenter of a financial bubble that collapsed in 1997. It started in July of 1997. I'm interested in bubbles, financial bubbles, economic bubbles, because they're getting more frequent. The thing to keep in mind is that 7 of the 11 so-called great financial bubbles or economic bubbles that have happened in human history have happened in my lifetime. 7 of 11. And I'm actually not that old. So they're getting more frequent and they're getting more destructive to more and more people. So I have a real interest in bubbles. And I thought, why not blend my interest in bubbles with a project I was involved in years ago, a documentary film called Taking Stock, Ancient Fears in Modern Greece. So what Taking Stock was really about human biases and human behavior, and you can't get a bubble without many of the biases that we uncovered and explored in Taking Stock. So I hope you enjoy this short piece on behavioral finance, and I look forward to receiving comments and feedback at the end.
I've worked with Terry Burnham, and he is an economist. And I should say this, the first time I met him, he said, I want to learn everything you can tell me about human behavior. And I said, you study economics, who cares? It's about buying stocks. It's about learning about your IRA. And he said, no, he said, when I first went into it, that's what I thought it was. And I realized economics is about human behavior.
What it appears is there are these systematic biases that affect how people process information.
So even great experienced traders are aware of these biases.
And what we have found, and the reason that this documentary is being made and this research is being conducted, is because it is systematic.
Okay, so we have these systemic biases. What's the big deal? Well, the big deal is the fact that we have these biases that cause us to do ourselves enormous harm, and we can overcome these biases with a little bit of knowledge.
The evidence is that individual investors, every time they make a trade, they make themselves worse off.
I said, let's take a look at when an investor sells one stock and buys another stock. If on average, the stock he buys doesn't outperform the one that he sold by enough to cover his trading costs, he's trading. So I took a look at the trading records for 10,000 investors at a large discount brokerage firm where they were making their own trading decisions. And I found that the stocks that these people bought were going on to underperform the stocks that they sold.
The stocks they buy do worse than the stocks they sell.
So, they would have bought 3 percentage points a year, and that was before taking out the commissions they were getting.
They tend to underperform throwing darts, which is hard to do.
So not only were they not covering their costs, but they were losing money before costs.
They pay transactions costs while they're at it. Why do
the more often they trade, the less money they have.
Why do they do it? It's because they have the illusion that they know something.
As my former teacher and mentor, Danny Kahneman, said about this study, it's expensive for these people to have ideas.
Left to their own devices, people engage in all kinds of self-harming behavior. They engage in dozens of activities that cause them self-harm. We're only going to talk about a few of them here because, after all, it is Patrick Doyle's short introduction to behavioral finance. But one of the most important ones, at least as far as bubble formation is concerned, is herding. Now, think about herding, or the way I think about herding is monkey see, monkey do. It's how you follow your neighbors and do what they do. And sometimes this can be good for us, but in the domain of finance and money and investing, it often causes us pain. And herding is not just important to bubbles. Herding causes markets to have wilder swings than they otherwise would.
On October 19th, 1987, stock markets all around the world fell by 20% or more. How can that happen? It was a day with no news. The only news was that markets were falling all around the world. Why did it happen? Well, it's just because if everybody else is selling, I feel like I better be selling too.
So think about the following idea. You go to Starbucks for the first time. You walk by, you're doing some errands, you're tired, you're thirsty, you see Starbucks. Dunkin' Donuts is 5 blocks away, so you walk in. You walk in, you're surprised by the prices, but you decide to buy a cup of coffee. You buy a cup of coffee, you enjoy it, and you walk out, you continue your errands. The next week when you pass by, what do you remember? Do you remember how thirsty you were last week? How caffeinated deprived? How tired you were? Probably not. But you remember your decision. I remember walking by this Starbucks before, I remember going in, and now you say something to yourself that is very much like herding. You say, I did this before, therefore it must be a reasonable decision. Therefore, let me do it again. In a sense, you're following other people, but the other people you're following, many times it's you and your past decisions.
We're influenced by other people. We do all kinds of things that are inexplicable other than the fact that other people are doing it.
More capital goes in, the value of those assets go higher, which draws more capital from entrepreneurs into it, which drives ultimately down the returns. And that is over and over repeating process throughout economic history.
So we get caught up in the herd. If we go back to the 90s and ask, how can it be that this big bubble in technology stocks happened? Part of it is that our friends were investing in those stocks, and there was a kind of stock jealousy. So, my neighbor bought Amazon and invested $10,000, and it's now worth $100,000, and I'm thinking I'm an idiot because I haven't done that, and the whole thing builds.
Another problem is the fact that we are overconfident as a species on average. We think we are better at many activities. We think we're more athletic, we think we're smarter, and we think we're better at picking stocks. And the problem with that is we're not actually much better at picking stocks in the market. Most individual investors left to their own devices actually underperform random chance, which is hard to do. So there's a disconnect between our level of confidence and our skill in this. And the faster we realign our view of ourselves with the reality of ourselves, the better off we will be.
Well, there's a whole series of studies that have been done by a number of people in various fields, whether it's finance, economics, or organizational behavior and psychology, that have illustrated how powerful this overconfidence phenomenon is.
The most comical bit of overconfidence is that in a study where men were asked about their athletic ability, every single one of them, 100% ranked themselves as above average. Surely we know everybody can't be above average.
I want to explore an idea that was brought up by Professor Richard Thaler earlier, and that is the illusion of knowledge. It turns out when it comes to investing, our biggest problem isn't ignorance, but it's the pretension of knowledge. Or as Mark Twain said, it ain't what you don't know that's the problem, it's what you know for sure that just ain't so. Think about the following idea. Every time you need to make a decision about whether it's an investment or where to live or who to marry, any decision you need to make, that decision is informed by information. And the information can be broken into the signal and the noise. Now the signal is all that stuff that is germane to your decision and will help you make a better decision. And the noise is the sort of mental flotsam that has no real bearing on your decision, but it will influence you. Now, when it comes to giving people more information, it's not like the signal gets any stronger. When you give people more information, the signal actually gets weaker relative to the overall amount of information they get. So the signal gets weaker as they receive more information. This is an idea that was explored in a great book by a guy named Nate Silver in a book called The Signal and the Noise. In addition to the weakening signal, they also become more overconfident. So people think, as the signal's getting weaker, they think they're getting better at making a decision because they have access to more superfluous information. And so they're hit with a double whammy as they receive more information.
We saw this contribute heavily to the bubble in the late 90s. because the bubble occurred simultaneously with the great growth in the internet. And all of a sudden, individual investors could get lots of information on websites like Yahoo Finance.
Believe that I already know the answer, then I'm not going to be very good at listening to people or actually pursuing information search, because information search is costly. So what I want to do is if I think I know the answer, I'm going to stop the costly process of gathering information and go with what I think.
All of a sudden, any Joe could get all this information that was only available to professionals 5 years earlier. What that made them think is they knew something. There's research that shows that the more information you give people, the greater this illusion gets. Now, of course, this information is available to everybody. There's no reason to think that because I'm looking at Yahoo Finance that I know something that 8 million other guys don't know, and that the professionals didn't know last week. I get trapped into thinking that I know something. I'd say the first lesson for investors would be, you don't know anything, and act accordingly.
Media, to entertain you, they get you to focus on what's different today. They won't go back and remind you about what the central core issues are you have to keep in mind if you're going to be successful in the long term.
You read the newspaper, only read the sports section.
Because the news is about what's different, not about what's the same. And it's about what's the same that is it makes success for most investors.
I strongly advise against reading the financial pages. You're much better off following the baseball scores.
Now, to be fair to Professor Phelan and Professor Shefrin and others that poked at media just now, they're poking at media because we asked them when we filmed them specifically about media. But media is just one example of a bigger issue, which is our desire to find narratives to help make sense of an increasingly complicated world. So media, as a group, are one of the people that we employ to help us with this impossible task. Economists are another group, financial forecasters, and so on. The real issue here is if we want to solve the problem of trying to find a narrative to make sense of a complicated world, the first place to start to solve that problem is to look in the mirror. To help express this idea, I'll use an example that's near and dear to every YouTube viewer's heart: Canadian football. Now, as everyone knows, the Toronto Argonauts were the winners of the 2012 Grey Cup. We know that they beat the Montreal Alouettes in the final game. We also may remember that at the beginning of the season, Toronto was a rebuilding team, and they were having some difficulties early in the season. Now, the forecasters, the people who spend time deciding who's going to win the Grey Cup and commenting on each game, the people who basically live and breathe football, many of whom are former NFL players or CFL players themselves, they could not see, calling Toronto as winners of the Grey Cup. They anchored on a decision that Toronto was not going to win the Grey Cup, and even as information about Toronto winning consistently came to them, they refused or they couldn't change their view. And even at the final game, they couldn't imagine Toronto would win because they had anchored on an idea. They were upset, and the rest is history that everyone's aware of. It was a great game. Now, when it comes to investing, we suffer the same sort of problem. We build a narrative of the world, and we cling to it, and we can't let it go, and that really, really hurts us, which is another issue associated with excess information, because we only look at information that supports our prior view, and we discount information that refutes our prior view. So in order to make an investment plan that is based on a narrative, you have to do a lot of things that are really, really difficult to do. Let's just go through them. First, you have to form a very accurate view of the world. You have to overweight certain facts, and you have to underweight certain facts, and you have to completely ignore some of the half-truths that float around a modern capital market or a modern investment arena. Secondly, you have to change your view. Unlike the football forecasters, you have to change your view on an ongoing basis to fit the narrative with the world that your business is operating in. So a thing will change in your business, and you have to be very adaptive in your ability to change your perspective on your underlying investment. Third, you have to realize that the surrogate that represents your investment, the stock, behaves according to rules that have got nothing to do with the underlying fundamentals of the business often. They move up and down with the herd. They have, the stock is driven by things like interest rates or the behavior of other investors, or whether a bunch of investors need to sell to, fund a vacation or an education, things that have nothing to do with your business, but, will affect the value of your business in the short term at least. You have to form a good view of what's relevant and what's germane in terms of the behavior of the surrogate. And finally, you have to know more about this business than the people who live it and breathe it, the people who go to work at that business every day, the people who study that business as financial forecasters or financial analysts every day. And so my advice to people would be, you can't really build a successful investment plan based on narrative, because there are just too many impossible tasks. I mean, if you think about football forecasters failing to predict that very famous game between Toronto and Montreal, my advice is you don't have a hope as a small investor, so don't even try. One of the other problems that we uncovered when we interviewed these experts is the idea that we have a really, really hard time accepting a loss. In fact, one of the experts told us about their mother. And in the interest of family harmony, I'm not going to mention which expert it was, but this woman had, made a bunch of investments over the last 15 years that have gone down in value, but she refuses to take the loss because she keeps telling herself every time she opens her brokerage statement, she says it's going to come back. So this is a very, very common phenomenon in people, and I think it's one that deserves comment.
When we feel that we've lost something, our ego gets in the way, our difficulty of admitting to a mistake gets in the way, and so we go for it. This leads to a lot of bad behaviors, because obviously it makes sense. We can understand why we should be averse to losses, and in and of itself, that is not a bad instinct to have.
The reflective part of the brain is saying, stay calm, probably it'll go back up. In any case, I don't really know what to do about this anyway, so the best course of action is to do nothing. But the automatic part of the brain is screaming, panic, do something, sell, buy, do anything.
One of the alternatives is just to accept that you've lost something. But you have an alternative action you can take. Instead of accepting this sure loss, you can take a gamble where you have to beat the odds in order to break even. The problem is that because it's such a strong aversion to losses, it causes us to take bad risks later. So you think about someone like Leeson, who brought Bearing Bank down because he made an investment. He lost some money, and in and of itself, that loss wouldn't have been catastrophic. Just like lots of investors, they make a bad investment. That's not the end of the world. Aversion to sure loss is taking a bad bet, hoping to beat the odds that you will come out whole. And the thing about the nature of a bad bet is that the law of averages says if you take this bet, in the long run, you're likely to lose. If you take this bet consistently, it's almost sure you will lose. And if it wasn't the case that the alternative was a sure loss, you would never take this bet. It's that bad. And therefore, that becomes a self-fulfilling prophecy that we end up losing more than we would have otherwise because we're so afraid of losing what we lost initially. The end of the world is when they start doing crazy things saying, I've just got to get even.
When I was a young kid, I first learned about the Greek classics, the Iliad and the Odyssey, through film. When I was a little kid, I was transfixed by this stuff. I thought it was wicked and decent because they have things like cyclopses and, monsters created by the awesome Ray Harryhausen. So on the way back from Troy to his home in Ithaca, Ulysses has to pass, these creatures called sirens. And sirens had a voice that was so beautiful that they would lure sailors to their death. Now, Ulysses wants to hear the siren song, but he doesn't want to be led to his death. So what he does is he jams beeswax in the ears of all of his men, and he has his men tie him to a mast so he can listen to the siren song. But he orders his men not to let him, not to untie him until he gets free of, or until they're all free of the siren song. They can no longer hear the siren song. It's relevant to process because we need to build systems for ourselves that will help us outwit or outsmart all of our more base instincts or all of our more self-harming biases in the way that Ulysses did to hear the siren song but not be harmed by the siren song. Another thing I want to say about processes is that I believe there are many roads to Rome. And what I mean by that is that there are lots of different ways to achieve your goals. There's no sort of one true and only path. So I know for myself, I like to buy companies that have high return on assets that are cheaply priced. That's my process that I engage in. But there are people who may engage in technical analysis. There are people who may invest in growth at a reasonable price. It may be successful for them. The point is that every process has to engage the rational part of your brain, the planning part of your brain, and try to minimize your instincts as much as possible.
I won't become unbiased. The best I can do is reduce the amount of bias that I express. It's sort of like the old joke about the bear that you run upon when you're hiking in the Rockies, you and your colleague, and the punchline is something along the lines of, I don't need to outrun the bear, I need to outrun you. Well, it's the same sort of thing. I don't need to be a perfect decision maker. I just need to be slightly less biased than you. And in competitive situations, that will make me better off in the long run.
If the market drops 200 points in the first hour of trading, the automatic part of the brain is in panic mode.
This notion of the rational actor who is without emotion and who simply value maximizes is maybe a standard. Maybe somebody to whom we might want to say, well, that's one way of looking at how people are going to behave, but it doesn't predict how you will behave.
What are we going to do if tomorrow the stock market drops by 4%? What kind of changes will we do to our strategy? And we could decide it's a better year to sell, we have a winning strategy, let's hold on to it. And even if people get crazy tomorrow, it's still the best thing to do from our analysis. But tomorrow, if the market does go by 4%, and we feel the emotion, it's not a hypothetical question about what will happen tomorrow. We actually feel we have lost 4% of our wealth, and maybe we've lost 4% to a lot of people's wealth, and this new emotion of fear and anxiety and so on could take over in a way that would make our decision from yesterday be non-relevant.
It's important for people to design systems for themselves.
And you highlight George Soros and Warren Buffett are people who are not making instinctual decisions. They have processes.
So that the automatic part of the brain doesn't get you in too much trouble.
We take the short term out of the equations.
And those processes are very deliberative, and in many ways they're slow moving.
As investors ourselves, we do a number of things to force ourselves to think in the longer term.
So Warren Buffett will go years without making an investment. He'll say, I'm not finding anything that's of good value, and he has a very, very well-defined process. And that process really engages the prefrontal cortex.
So whenever we analyze a company, an investment, we try to think about how will it do in a downturn and how will it do in an upturn.
So the take-home message for most investors is to make sure that you're making your financial decisions using the rational part of your brain, that prefrontal cortex, and not with the emotional part, the lizard brain.
Now, I'm just like any other human being. I like to receive a piece of short-term information that positively reinforces my view of the world. When I receive something that negatively reinforces my view of the world, it causes conflict. Either a conflict with my ideas wrong or my assessment of how the world functions is wrong.
That process itself can be relatively invariant, even in changing environments. So, for example, you'll always know that it's better to buy things that are unpopular that which is unpopular may vary dramatically over and will vary dramatically over time.
Whatever's in favor will ultimately have lower returns over a long period of time because more and more capital will go into it.
And again, I like sports analogies. You know, you can have a consistent process of working hard, watching tapes, studying yourself, looking for weaknesses in yourself, studying your opponents. The particulars will vary dramatically over time for yourself, for different players, and for different opponents, but the process can be the same in every environment.
Getting negative feedback on something you do is really, really difficult for anyone to deal with. Knowing that up front can help you overcome it.
One of the most profound ideas in our movie, Taking Stock, Ancient Fears and Modern Greed, came to us from Professor Terry Odean out at Berkeley. And he talked about the fact that as the 1990s stock market bubble or the technology bubble expanded, those people who were more pessimistic as the market increased in price either changed their tune or they changed their jobs. So pay attention to what Terry Odean says here because I think it's really quite profound.
If you go back to the mid '90s or let's say 1997, some analysts thought that many of these stocks were overvalued. Some thought they were undervalued. The stocks went up. The analysts who perhaps had been less optimistic, changed their tune or changed their job. The reporters who were pessimistic, they probably again changed their tune or they changed their job. And many of the money managers were people who at least had gotten to where they were by believing. And as we know, many of the analysts were a tad optimistic, at least publicly.
This is relevant to me particularly given my experiences on Bay Street. For those of you who don't know, Bay Street is Canada's equivalent of Wall Street. I found this in my own experiences on Bay Street where people had a sense that the price movement of a stock reaffirmed their view or disconfirmed their view. Is that we're quite short-term in our perspective, in that if we have a view and the price acknowledges our view today, we feel vindicated and we feel good. If your view is not vindicated immediately by price, you're quick to change your view in some cases. And so I think that's self-destructive in a way because you are short-term sort of feedback loop between you and the market can cause you to enter a herding type behavior. And the second thing that's relevant is that it takes years for people who are skeptical about a bubble to be vindicated. So Warren Buffett, for instance, didn't participate in the technology bubble, and he was mocked, ridiculed in the press for the years leading up to its eventual, crash. The market eventually creates a sort of homogeneity of opinion. Everybody starts to think alike. And when everyone starts to think alike in a market, that's a very dangerous thing for a bunch of reasons. Anyway, it's an idea that I want to explore in greater depth in another project later on. Okay, that about does it. Wraps are all up. First, I'd like to thank the many people who made Taking Stock, Ancient Fears and Modern Greed, the original movie, a possibility. Primarily the experts who helped us out, the academics and practitioners who generously gave of their time. I'd also like to thank my co-writer and director on the project, Ross Goodfellow. You can learn more about Ross and his many talents at www.independencefilms.ca. And I'd also like to thank my fellow producers on the project, Chris Ballinger and Burnham. Obviously, they did a brilliant job as well, and the project couldn't have happened without them. So thank you very much for your time, and I look forward to receiving some feedback.